Hi everybody, today I'm going to talk about SRS, Supplementary Retirement Scheme, and what can you invest in using your SRS. Before we talk about what can you invest in, let's look at what actually SRS is. SRS is a voluntary scheme that encourages individuals to save for the retirement. And as a Singaporean or PR, you can put in 15,300, and foreigner you can put in 35,700. However, when your money is put into the SRS account, it will be locked in until age 62, then you can do a withdrawal. Thus, for every dollar of SRS contribution, you reduce our taxable income by $1. Thus, if your tax relief is less than 80,000 per year, when you contribute to SRS, you will enjoy tax relief. For those who have more than 80,000 tax relief, SRS may not make sense for you. However, this will only belong to the minority group of people. Okay, let's talk about the withdrawal side of SRS. If you were to put in your SRS at 62 when you do a withdrawal, 50% of the income will consider tax exempted. Thus, if you were to withdraw 40,000 out from SRS account every year, actually it is completely tax free, as the first 20,000 of income is tax free in Singapore context. However, if you were to withdraw your SRS before age 62, 100% of the withdrawal will be considered as income and will be subjected to tax. And on top of that, there is a 5% penalty of the premature withdrawal amount will be imposed on that. So thus, does it really make sense for you to contribute SRS, and does it really worth your time? Let me use this tax bracket as an illustration. Every year, let's say you contribute 15,300 to the SRS, you will have a tax savings of slightly more than $1,000. What happened? Let's say this year I contribute 15,000 inside, and next year I lost my job, and I have no income, and I need money. So if I were to go to SRS account to cash out my money, the 15,000 I withdraw will be subjected to tax. However, the first 20,000 is tax free. So even the amount I withdraw out, I still don't need to pay any tax. However, I'll still be subject to the 5% penalty. So I'll need to pay a penalty of $750 if I have to withdraw 15,000 out. But compared to last year where I made a SRS contribution of 15,000 inside, my tax saving is actually more than $1,000. So in the end, there is still certain amount of tax savings inside. If happen that you really need to have a premature withdrawal. Let's say you contribute for 2 years, 15,000 per year, and total you contribute 30,000 for 2 years. And on the third year, you need to do a premature withdrawal due to whatever financial reason and loss of no income. Let's say you withdraw the full 30,000 out, you will need to pay an income tax of $200, as the first 30,000 of income tax is $200, and plus a 5% penalty is $1,500. So actually the total cost you need to pay is $1,700. But compared with the 2,000 plus saving you have enjoyed over the past 2 years, you still have certain form of tax saving. So thus, does SRS really worth your time? Is the higher your income tax bracket is, actually the more tax savings you will enjoy, despite the penalty you expect. Let me just do this illustration. For example, if a person has been contributing for SRS diligently every year of 15,300 for 20 years before his retirement, and we do a conservative assumption that he only grow his SRS money at 2.5% per year. By the time when he retire and start to withdraw the money out, the money will grow to 391,000. And he can withdraw over the 10 years period, where indirectly he will withdraw an income of 3,262 per month tax free for the next 10 years. And the tax saving he saved for the 20 years, let's say he's on a 7% tax bracket, he easily saved more than 20,000 in income tax. So this is an example of how SRS can benefit you for this aspect. What happened at you make a better returns compared to 2.5%, and let's say you make a 6% returns for SRS and it grow to 565,000. And you withdraw over 10 years, let's put an average of, let's say you withdraw 56,000 per year, and anything in excess of 40,000 you need to pay tax, correct? But the tax amount is paid is maybe around $200. But compared with the $20,000 tax you save, okay, based on 7% tax bracket for the past 20 years, plus the future tax, you need to pay maybe about $2,000. It still makes sense for you to contribute to SRS. So thus, I actually encourage everyone, for those that don't have any SRS account, please just go and open one SRS account. So how to open an SRS account? You can just need to go log into your internet banking either by DBS, OCBC or UOB, and through online application you can open your SRS account online, plus just put in a $1 in to lock in the retirement age. What do you mean by that? As currently the withdrawal age for SRS is 62, okay, based on the current statutory retirement age. So you put in $1, actually you lock in the retirement age. If what happens and in future that the statutory retirement age were to increase to, let's say, 65, at the point of time, then you open an SRS account, then your SRS withdrawal can only withdraw at 65. Thus, I encourage everyone that if whether you need an SRS account now or in future, just go and lock in the withdrawal age is 62. However, do take note that it is not necessary to withdraw your SRS at 62 if you are still working at the point of time. Some of you may have want to work under 64, 65 years old. So at the point of time, you can still contribute to SRS and you no need to withdraw SRS. The withdrawal period is 10 years counted from the day you start to do the withdrawal from 62 onwards. Let's say you start to withdraw SRS money from 66, then you only need to finish the withdrawal by 75, okay, instead of 71. So that is called a 10-year withdrawal period. What can you do with your SRS money? Do take note, SRS account only earn you 0.05% interest. This is a misconception. A lot of people have that. They thought that it's a retirement account that give them 4% return. That one is the CPF special account and retirement account. For SRS account, you will earn the prevailing savings, bank savings rates, which is 0.05%. Thus, do take note that the worst thing to do with your SRS money is just to put inside and don't do anything, as you will only earn 0.05% interest. So you may need to grow your money on the SRS account, but for those that don't want to take risk, what are the options you have? Okay, you actually can put your SRS money into fixed deposit, be it Singapore dollar fixed deposit or foreign currency fixed deposit, as several banks will accept SRS money for fixed deposit. Putting in fixed deposit is definitely better than putting your SRS money in the SRS account and not doing anything. You can even invest in Singapore government securities or Singapore savings bond, which will definitely reap a better return than even the current fixed deposit rate, and it is capital guaranteed, return guaranteed by the Singapore government. So indirectly, it's a risk-free way of investing. For those that want to have a form of capital guarantee portion and potential higher return, you can even look at the single premium endowment and retirement plan by the insurance company. Several insurance companies will have plans that cater for SRS. So this is just some example like the AIA Manulife or NTUC plan. They were able to take in the SRS money, and mainly is for you to plan for a retirement or long-term savings side. For those that are willing to take more risk, you can buy the fixed income, which is called a retail bond, that's listed on SGX. Currently, we have 10 retail fixed income and perpetual securities that allow you to use your SRS money to invest in. But do take note, you need to have a stock brokerage account in order to invest your SRS money. You can also use your SRS money to buy unit trust, which there is more than 1,000 unit trusts that allow you to invest using your SRS money. With that, it can help you to invest with overseas market and also in the overseas bonds market aspect. And do take note that there are platforms in the market that when you use your SRS money to invest, you don't need to pay any sales charge, switching fee, or platform fee, or any ongoing charges. And thus, what you see is what you get when you use your SRS money to invest in the unit trust. For those that want to invest in ETFs, so currently there are about 46 ETF that's listed on SGX that allow you to use your SIs to invest in. However, do take note, some of the ETF may be illiquid and can be quite high risk. So do remember to do your due diligence when you want to use your SIs money to invest in all those ETFs. And SIs also can invest in a 30 over REITs that's listed in SGX, whether it can be a Sing dollar denominated REITs or a US dollar denominated REITs. As long as it's listed in SGX, you are allowed to use your SIs money to invest in. And of course, you can use your SRS money to invest in the Singapore stocks, which is listed on SGX. So this is just some of the example. Okay, but what about foreign shares and ETF? SIs do not allow you to invest in foreign shares and ETF, like for shares listed in the Hong Kong market, ETF listed in the US market. You are not allowed to use your SIs to invest in the market. So practically for SIs, you can only invest on unit trust or those counter shares, REITs or ETF or retail bonds that is listed on SGX. Of course, there is alternative to use the SIs to invest in foreign shares. That's what I call the managed account services, where actually our team actually help our client to take their SIs money to invest in foreign market through the managed account services. This is what you can do with your SIs money, which is the best product for you to invest in. It just boils out to what it suits you most. For example, like let's say you plan to buy the OCBC bank shares and plan to keep the shares for long term. Instead of buying the bank shares directly using cash, I encourage you that why don't you just put your money into your SIS account and use the money to buy OCBC shares. You will save on tax and also possible to save on brokerage commission. But some of you will say that I will prefer to buy foreign shares instead of local shares. We have to look at as a portfolio basis. And you will want to buy Singapore shares or all those products that's listed here, you can use your SIS money to buy. And you definitely have certain proportion of money in cash, and you can use this cash to buy foreign shares. So this is more of a portfolio allocation. How does SIS really make sense? To me, that SIS will make sense to those that plan to lock in their money for retirement and also who want to grow their money at the same time to enjoy tax savings. Okay, it should able to form part of your portfolio allocations for your retirement years. That's all I have to share with you today. If you feel that this video benefit you, do remember to like and share, and also leave your comment below to let me know what you think. And do remember to subscribe and press the bell button so that you'll be notified on my next video. I shall see you in my next video. Bye bye.